Hello and welcome. Today let's talk about insurance. Why do you buy life insurance? 1. To provide financial protection to your loved ones if you pass away. 2. To get tax saving benefits, that is ATC deduction up to 1.5 lakh for the premiums that you pay and tax free maturity proceeds. Now, with this principle, let's say you decide to buy life insurance. Now, if you decide to buy this in the early stages of your career, then life insurance is not going to be expensive. But if you decide to do this at later stages, this is when things get tricky. As you get older, premium becomes higher. On top of that, if you have any pre-existing medical conditions, then even if you are ready to pay this expensive premium, sometimes buying insurance itself would be a challenging task. So life insurance is inexpensive if you buy it when you are younger and healthier, otherwise it is going to be costly. Next, let's talk about returns. Even in comparison with other low risk, low yielding investments like fixed deposits, returns that you get on life insurance is low, but you would still be able to get financial protection for your family. Let us now talk about the other reason, tax saving benefits. First, ATC deduction. This deduction is limited only to those who opt for old tax regime. So if you are into new tax regime, then you don't get this deduction benefit. Next, tax-free maturity proceeds. Even this is not true for some of life insurance policies. Especially after the recent change effective from 1st April 2023, maturity proceeds in some situations have now become taxable. When it comes to taxing of maturity proceeds, this is not something new. If we go back in time, in 2003 itself, maturity proceeds were made taxable if annual premiums paid is more than 20% of sum assured. Later on in 2012, this limit was reduced to 10%. Let's say in 2022, you have bought life insurance, sum assured 10 lakh, 5-year term, so premium 2 lakh per year. Now this premium as a proportion of sum assured is 20%, which is more than the threshold limit of 10%. So maturity proceeds here is going to be taxable. Instead of 5-year, had you gone for 10-year term, then premium would have been 1 lakh per year, which is 10% of sum assured, in which case you would be able to enjoy tax saving benefits. But with effect from 1st April 2023, even these provisions have undergone changes. Now, instead of 10%, a new concept of threshold limit for annual premium is introduced. So, if the annual premium is within this threshold limit, then maturity proceeds are going to be tax-free. We'll shortly understand what this threshold limit is. So, if the annual premium is more than this threshold limit, then maturity proceeds are fully taxable. Now, for the purpose of today's video, let's say these are high value insurance plans. After this basic understanding of life insurance, we get to learn two things. One, not all taxpayers get tax saving benefits, because if you are into new tax regime, then you don't get this ATC deduction benefit. If you would like to know more about new tax regime, what deductions or exemptions you get and what you don't, you may consider watching the playlist, the link in the top right corner. Second thing, not all life insurance plans offer tax saving benefits, because we have just seen that maturity proceeds in some situations are going to be taxable. So in today's video, we are going to focus on this aspect. So let's take a deep dive and talk about taxability of maturity proceeds of these so-called high value insurance plans. We are mainly going to discuss about changes effective from 1st April 2023. Once you understand this concept, you would be able to clearly distinguish between tax-free and taxable maturity proceeds. This would help you make a decision whether to buy life insurance or to look for other options. In the end, we are going to discuss some of those options. So let's start by understanding the meaning of high value life insurance. These are life insurance policies issued on or after 1st April 2023, where premium is more than 5 lakh per year. Remember, this is yearly limit, not per policy limit. So if you have a single policy and if the annual premium is more than 5 lakh, then such an insurance policy is a high value insurance policy. Similarly, if you have multiple policies, then total, that is aggregate annual premium if it is more than 5 lakh, then insurance plans which exceed this threshold limit are high value insurance plans. We can also understand this from a different view. If the annual premium that you pay is up to 5 lakh, then such policies are not high value insurance policies. So maturity proceeds of these policies continue to be exempt. To have a better understanding of this, let's consider a scenario. Let's say you purchased an LIC policy on 1st April 2022. Annual premium is 5 lakh, sum assured 50 lakh. Term 10 years, so date of maturity would be 31st March 2032. First thing that we learn from this is, this policy is issued before 1st April 2023, so the recent changes are not going to be applicable. So we need to look for proportion of annual premium to sum assured, which is 10% here. Let's say maturity proceeds are 60 lakhs including bonus. So this 60 lakh is going to be tax free because proportion of annual premium to sum assured is within the threshold limit of 10%. But what if you buy other policies, say in the current financial year? Then in that situation, how is this threshold limit of 5 lakh going to be computed? Now to understand this, let's see some examples. Here is the first policy we have just discussed. Date of issue 1st April 2022, annual premium 5 lakh and sum assured 50 lakh. Let's say in addition to this, you have purchased 3 more policies, policy number 2, 3 and 4. For ease of understanding, let's say the date of issue of all these 3 policies is 1st April 2023. For policy number 2, annual premium is 1 lakh, sum assured 10 lakh. For policy number 3, 3.5 lakh and 35 lakh. And for the last policy, annual premium is 6 lakh and sum assured 60 lakhs. For ease of understanding, let's say the term is 10 years for all 4 policies. Let's now talk about taxability of maturity proceeds that you would receive in future. For the first policy, let's say you would receive maturity proceeds on 30th April 2032, 60 lakh. For the remaining policies, let's say you would receive maturity proceeds on 30th April 2033. For policy number 2, it is 12 lakhs. For policy number 3, 40 lakhs. And for the last policy, it is 70 lakh. Now, since the first policy is issued before the current financial year, that is before 1st April 2023, this premium will not be included in the threshold limit of 5 lakh. So, this is not a high value insurance plan and maturity proceeds from this policy is going to be tax free as we have just seen in our earlier screen. Let's now talk about policy number 2. Here, annual premium is 1 lakh. And since this is within the threshold limit of 5 lakh, this is also not a high value insurance policy. So maturity proceeds are going to be tax free. Let's talk about policy number 3. Here cumulative annual premium, that is premium from policy number 2 and 3 together is 4.5 lakh. This is also within the threshold limit of 5 lakh. So it is not a high value insurance plan and maturity proceeds are going to be tax free. Let's now talk about the last policy. Here, cumulative annual premium is 10.5 lakhs. That is total of premium for policy number 2, 3 and 4. And this is more than the threshold limit of 5 lakh. So this policy is definitely going to be a high value insurance policy and maturity proceeds are not going to be tax free. So your taxable income because of this policy for financial year 2033-34 would be 70 lakh. This is how maturity proceeds are sometimes tax-free and other times taxable. Maturity proceeds means the money that you get when you complete the term of the policy. Now what if you don't complete this term, say you cancel the policy or you surrender it, then in that case instead of maturity proceeds you would get something called surrender value. Now tax treatment of surrender value is same as that of maturity proceeds. Next, death benefit is not taxable. Death benefit is the money that the family gets in case of untimely death of the insured person. Now, this death benefit is not going to be taxable even if the annual premium is more than the threshold limit of 5 lakh. But here you need to remember few things. One, death benefit usually does not cover death by suicide, drug abuse, etc. Next, if you don't disclose any pre-existing medical conditions that you may have when you buy life insurance, then it is uncertain that the insurance company would pay death benefit to your family members. So you end up paying premium for a policy which actually does not provide any financial protection to your family. So it is crucial that you remember these things. So far, we have understood what are high value life insurance plans, what are tax-free and taxable maturity proceeds. We can say that although life insurance offers financial protection to your family, not all life insurance plans offer tax saving benefits, because we have just seen that in some situations maturity proceeds are also going to be taxable. So what's the way out? Is life insurance the only way, or are there any other options? Let's see. This would depend upon your objective. If the purpose of you buying life insurance is to get financial protection to your family plus tax saving benefits, provided you are in old tax regime, then life insurance is still the better choice, provided you are looking for limited coverage. That is, annual premium has to be up to 5 lakh. But it is wise to buy life insurance when you are younger and healthier, so that the premium is not going to be expensive. But if your purpose is financial protection plus tax saving and you're also looking for higher coverage, then life insurance is definitely not the suitable option, because maturity proceeds are going to be taxable. So what's the solution? Here, instead of life insurance, you may think about term insurance. Now, in case of term insurance, you don't get any survival benefit. That is, if you complete the term of the policy, then you won't get any money. But in case of untimely death, the family members get death benefit. And similar to life insurance, even for term insurance, you get deduction under section 80C up to 1.5 lakh for the premiums that you pay, and death benefit is not going to be taxable. Second thing, premium for term insurance is relatively inexpensive. But here again, you need to be cautious of disclaimer, that is, death benefit usually does not cover death by suicide, drug abuse, etc. But if the purpose for which you buy life insurance is tax saving, then it is high time that you stop buying life insurance or even term insurance for that matter. Instead, consider investing in other options. If you are ready to take high risk, then stock market is the best choice for you. But if you aren't comfortable, or if you are ready to take medium risk, then mutual funds or even ELSS, which offers 80C benefit, is the other option. But for low risk investment options, fixed deposit is the safe option. If you would like to know more about tax planning, you may consider watching the playlist, the link in the top right corner. So whether you want to buy life insurance or term insurance, or you don't want to buy it, it all depends on your purpose. This is all I have for you today. Hope the video was informative. Thank you for watching.